And hello. And hello.
Oh merde.
And hello.
Fuck.
Okay. The echo is finished. Good morning. Good morning. I'm a little bit late. Whoop. Hello. How's it going? Today we are back. Good thing there is a new article that came out yesterday, so we are on top of the news. Topic will be free AC. So I'm really looking forward to this one. I hope it will be good. So number three, theme, free AC and insolvent protocols. Really looking forward to this lecture. I hope everybody is doing well. Hope you're having a great day. And yeah, we'll see what we can learn together today. Let's take a look at the markets. So yeah, the markets, I mean, I'm still in my hedge position. I think it's still bearish. I will not change my analysis right now, and I hope that we will see a trend change very soon, because I'm kind of done with this price action. I think it's not the greatest at the moment. So yeah, in my opinion, better to just be sidelining and watch what happens. Okay. So let's start. Yeah, I really would like to see this resolve, either capitulation or a real push and then reconsolidation on top of supports. I mean, for now, here there's really nothing to do, honestly. For me, at least. Okay. Let's cut the music. And we'll get straight into it. I think I'll change the language to English again. Yes. Okay. Let's take a look. So I think this will last 1 hour, 1 hour and a half, and we'll just go through the article, try to learn stuff. Let's do it. Number 3.
Number 3. Any views expressed in the below are the personal views of the author and should not form the basis for making investment decisions, nor be construed as a recommendation or advice to engage in investment transactions. This current crypto nuclear bear market marks my third brush with generalized market carnage. And while they can sometimes feel like reruns, every episode yields new lessons to be learned. Everyone is always going to have their own view of what those lessons are, but if it's the mainstream financial media you're listening to, I can tell you with confidence that you're being fed the wrong takeaways. They, in the service of the devil that is TradFi, will use any and every opportunity to poke fun at our economic, social experiment, gleefully proclaiming, "We warned you crypto was worthless." In the holy name of our Lord Satoshi, I shall attempt to correct the invective that seeps forth from these malicious harpies. In this piece, I'll be using the 3 Arrows Capital 3AC saga as a lens through which we can better understand the true insights that should be gleaned from the current bear market. Please note, while I personally know Sue Ju and Kyle Davis, the principals of 3AC, I have no knowledge of what transpired other than what has been reported publicly. I intend to use my knowledge of crypto, financial services, and common sense to tease out the story of what I think led to its collapse, starting with the implosion of Terra USD and Luna. The collapse of 3AC in and of itself is unremarkable. A hedge fund that was previously successful executing boring but stable yielding arbitrage strategies decided to strap on leverage to accelerate returns, and paid the price. The use of borrowed funds to play the Terra USD carry trade sealed their death sentence. But what made the 3AC default so impactful is that it blew a whale shark-sized hole in many of the largest centralized crypto lending businesses. Due to losses on 3AC loans, many of these lending businesses have gated customer funds and become functionally insolvent. The withdrawal of credit from the crypto ecosystem has caused a generalized market crash of Bitcoin, Ether, and the whole pantheon of shitcoins. No coin has been spared. But what's conveniently going unmentioned by much of the media is that both centralized and decentralized lending companies, platforms had exposure to 3AC, and only the players in one of these two markets went belly up. The centralized lenders failed en masse, while their decentralized counterparts liquidated collateral and operated with no hiccups. Using the story of 3AC as the canvas, let me paint you a picture that illustrates why Lord Satoshi and Archangel Vitalik's creation stood the test of time, and what this means for the future of crypto.
Yes, I really believe this as well. I think we don't talk about this enough, but reality is that the real power of decentralization is that you add another layer of security and of trust. I think the more human, the more like you add personal choice to decisions, the more mistakes will happen. And the more mistakes happen, the more it's just difficult to justify a certain action, right? And yeah, for like with these constructions, with these decentralized constructions, at least it's automation, like it's automated, and you cut your losses, which basically save those guys in this specific scenario, like the decentralized lending platforms.
Of crypto. Hong Kong. Before we get too deep into it, though, let's first take a quick stroll down memory lane to better understand how 3AC's principals, Sue Ju and Kyle Davis, ascended to greatness. Sue and Kyle graduated university in 2008, the same year as myself, and at some subsequent point made their way to Asia Pacific as employees of TradFi banks, market makers. The Hong Kong, Singapore, and Tokyo investment banking scene is very close-knit. While I didn't know either Sue or Kyle directly until many years later, when we all entered crypto, we ran in adjacent circles of friends and were at most 1 degree separated at that time. The first time I met Kyle at a tempura restaurant in Singapore, I could have sworn I had seen him before at a party in Hong Kong. I never did any business with Kyle, who worked for a time at Credit Suisse, but I did trade against Sue while he was a market maker at Flow Traders. As the head market maker for the APAC Exchange Traded Fund ETF business at Deutsche Bank, I posted buy, sell quotes on the Hong Kong and Singapore stock exchanges for a large ETF product suite. I routinely made errors, and got served many ass whoopings at the hands of Flow Traders. No excuses, I just regularly lost money to them. Sue was one of the Flow Traders professionals who kept me on my toes on a daily basis. Sue followed up his time at Flow Traders with a stint at Deutsche Bank, and worked on an adjacent trading desk to Killa, who I talked about in a previous essay. The point of this story is that Sue and Kyle are arbitrage guys. In their banking careers, they were trained to profit off of small discrepancies in price. Do it over and over again, and the money adds up. They brought this same approach and mentality to their founding of 3 Arrows, which got its start by arbitrating the very inefficient over-the-counter non-deliverable forward NDF market. Now, moving on to my time at Citibank. While I was the head ETF trader at Citibank, I also dabbled in equity index forward trading, including NDFs. Our desk traded equity index forwards on the major Hong Kong, Taiwanese, Indian, and Korean indices. I also ran the entire China A-share ETF trading book and traded a large amount of equity-linked derivatives. An NDF is a currency bet, but instead of exchanging home and foreign currency cash flows at the start and end of the swap, the difference between the entry and exit exchange rate is paid or received in USD. Let's take the used CRU, Korean won, exchange rate. Korea does not allow Korean won to be freely exchanged. Assume I would like to sell KRW versus buy $30 days in the future and I want to lock in the rate today. I would trade on the right-hand side RHS of a used CRU NDF. If I enter the 30-day NDF at a rate of 1001 and the spot rate settles at 1201, I make 201 the USD notional, used CRU spot exchange rate. If I traded a size of $1 million that would equate to a profit of approximately $166,666. Understanding why NDFs are a necessary part of equity index forward trading isn't essential to this story, so I'll spare you the gory details. The OTC NDF market is very large and all the major investment banks have trading desks specializing in these derivatives. Back in the 2010s, trading happened over Bloomberg chat. That meant that while traders had a general idea how a particular NDF should be priced, they couldn't see a consolidated market like they could for spot currency.
Interesting. OTC NDF markets. Maybe, okay, do more research. OTC NDF markets. It's like a huge trading markets for trading desks. Then mostly arbitrage. Okay.
Currency. As a result, it was very easy to arbitrage the different NDF trading desks. Every day I would pick a currency and attempt to arb 2 trading desks. Let's say I wanted a $20 million notional 30-day KRW NDF. Bank A would quote me 1000, 1001. Bank B would quote me 1002, 1003. Do you see the trade? I buy at 1001 versus Bank A, and then I sell at 1002 versus Bank B. In 30 days I will net $1 per dollar in profit. On $20 million notional, that's a total profit of $20,000 assuming the spot rate is 1001. That's not much for a bank trading desk, but if you do this enough times, it adds up to a few $1,000,000 a year of risk-free P&L each year. As bankers, Sue and Kyle saw this inefficient market and used their own money to start a fund with a trading strategy centered around profiting on these mispricings. It's worth noting that unless you are a trader at a bank or extremely large hedge fund, it is almost impossible to trade in the NDF market. You must have an ISDA, and the senior management of the bank you are trading with must allow you to trade with them. But somehow, someway, 3AC managed to open accounts at a few investment banks and arbitrage them against each other in the Asian NDF market. When Sue and Kyle told me how they got started, I was pretty impressed they had hustled their way into this lucrative market. This is how 3AC made money for many years. Then, at some point, the firm discovered crypto, and plied their trade as cash and carry basis traders. This is the bread and butter of any crypto arb fund. The perpetual swap over its history has net paid shorts, which means if you sell USD, buy BTC, and then sell a BTC/USD perp, you will net earn funding over time.
Interesting.
These currency arb.
If you sell USD, buy BTC, and then sell a BTC USD perp, you net earn funding over time. Yes. Okay.
Arbitrage and funding trades are very profitable, but they are also capital intensive. You must post margin to trade every NDF derivative, and you will not get credit for having the equal and opposite position at another bank. For the crypto perp funding arb trade, you cannot use any leverage. This means that the growth of your hedge fund's AUM is slow and predictable, but you won't be starring in Big Pimpin' anytime soon. The only way to juice the performance of your hedge fund is to become a directional trader, and or use borrowed funds. 3AC did both. From the horse's mouth. We have been long crypto for a while, Davis said. We've not always been long Ethereum, in fact we've been short for periods of time, too. What's the best way to beat Bitcoin right now? Well, it's just to own Ethereum. The ultimate goal of my book is to outperform Bitcoin. Davis said that Ethereum is currently the firm's largest cryptocurrency holding. It has gained 245% this year compared with the US dollar, while Bitcoin is up 29%.
Yeah.
Source, Bloomberg. Terra USD, Luna. This cycle's carry trade of the century was sponsored by Do Kwon and Terra USD. Terra USD UST was a DeFi algorithmic stablecoin. The goal of the code underpinning UST was to attempt to maintain a one-to-one peg with the USD. I discussed how this peg worked in Luna Brothers incorporated the hard part for any currency that does not derive its value from the barrel of a government-owned gun is generating intrinsic demand. When 10,000 Bitcoin were exchanged for a Papa John's pizza in 2010, that marked the first known transaction of Bitcoin for a real-world good. That was extremely important, because it meant that the hodler of a real pizza believed some Bitcoin was enough to compensate him in the transaction. So how did Terra USD go about convincing people to use USD? Easy. Another Terra ecosystem project called Anchor offered a fixed 20% yield on staked USD. If you pledged your USD to the Anchor protocol, you earned a continuous rate of interest that annualized to 20%. How did Anchor generate such a stupendous yield? My trusty research analyst sleuthed this out for you readers. Borrowers paid 10 to 12% APY depending on their protocol. Borrowers were incentivized with distributions of ANC as a reward for borrowing, usually around 7%. Anchor would also stake its collateral funds to receive staking awards. These were not enough to shake off the incredible imbalance in demand between borrowers and lenders. Anchor also had a reserve, mostly financed by the Luna Foundation, which would help cover the difference between 10 to 12% and 20%. The idea was that eventually the Terra ecosystem will grow enough that it can support the high APY. But the reality was that Terra continued to burn its reserves and would have eventually run out of money. Terra was essentially paying for Anchor's growth and adoption. The hope was when the subsidies expire in 2024, there would be a vibrant ecosystem for savings and loans on the Anchor protocol. Source: Medium. A 10% yield deficit is a big hole to fill when billions of dollars are pouring in to receive the advertised 20% APY. Neither Anchor nor Terra survived long enough to ascertain whether the ecosystem could support a removal of the subsidy. Very few money managers stopped to engage the critical thinking part of their brain and ponder how the fuckity fuck Anchor generated these yields. But it didn't matter, because up until the crash of UST and Luna, it paid out 20%. This was the mother of all crypto carry trades. I'm sorry, but I need to beat this particular draft horse to death. I did a bit of analysis on the roughly 3 million bonds that Bloomberg indexes. I specifically screened for bonds with a maturity of less than 1 year, and a yield to worst of at least 20%. Out of 3 million bonds, only 159 fit these criteria. For those of you who like maths, that's less than 0.01%. Included in this list of extremely high-yielding instruments are...
I did a bit of analysis on the roughly 3 million bonds that Bloomberg indexes. I specifically screened for bonds with a maturity of less than 1 year and a yield to worst of at least 20%. Out of 3 million bonds, only 159 fit this criteria. Okay. So 20% yield on a stable. Sorry. So on a stable is unseen in any market, equal from 3 million bonds fitting, doing research with the criteria of Luna Terra. Only 159 fit the criteria. The fit similar criteria. Yeah. And here we're talking bonds from countries such as Sri Lanka, Ukraine, Argentina, Turkey. Yeah, so basically like second world, developing but second countries. Okay, wait a second, I'll go grab a coffee. I'll be back. 1 sec. And I'm back. Sorry. Yes. Sorry. Okay, let's keep going.
Are bonds from countries such as Sri Lanka, Ukraine, Argentina, and Turkey. To state the obvious, lending to these sovereign governments has been a road to ruin for investors for centuries. If these are the sorts of entities that pay 20% yields, what does that say about Anchor's ability to do the same and ensure the repayment of principal? Any so-called institutional money manager who poured their own or their clients' funds into the Terra USD carry trade and was surprised when they lost all their money should find a new line of employment. Back to our boys at 3AC. The reason why I rambled on about Hong Kong history earlier is because I want you to understand how these guys initially grew their fund. A carry trade like USD cannot be ignored, particularly for folks like Sue and Kyle, who have been big proponents of DeFi and who made a lot of money directly betting correctly on the growth in price of a number of other protocols. We know that 3AC held a large amount of Luna, but what we don't know is how deep they were in the USD carry trade. Davis said 3AC invested over $200 million in Luna tokens as part of a $1 billion raised by the Luna Foundation Guard in February, an amount that is now essentially worthless since the Terra ecosystem imploded in mid-May. The Terra Luna situation caught us very much off guard, Davis told the Wall Street Journal. Source: Wall Street Journal. The USD carry trade was very simple. Borrow USD at less than 20%.
Joseph Rane.
Convert USD into USD. Deposit USD into Anchor and earn 20%.
Yeah.
Annualized unrealized profit equals 20%, borrowing costs. To realize a profit, they would do the reverse. Withdraw USD plus interest in USD from Anchor. Convert USD into USD. Pay back your USD loan. The residual is your profit. Using your own.
This is super interesting because this carry trade makes no sense. Yeah, so basically with the 20% yield, you're outperforming the borrowing rates. And then you have the other side of the trade. Withdraw USD interest from Anchor, convert to USD, pay back USD loan, residual is your profit. So yeah, okay, so again, like their percentage change. So the USD carry trade is again the percentage trade between the USD Anchor yield and the payback loan they had. So essentially, this is completely nuts. Carry trades equal yields lend USD from protocols by locking assets. By locking assets, then transfer the borrowed USD to USD, put in Anchor 20% annual yield, payback difference between loan rates and yield. Payback loan rate equal win on percentage difference between payback and annual yield. It's like free money. It's literally free money with this method, but of course it was not free, but they figured it out later.
Your own capital as a hedge fund severely limits the profit potential. A real master of the universe, when presented with such a juicy carry trade, levers up by borrowing money. Imagine you could borrow $1 billion at 10% APY, collateralizing it with a portfolio of shitcoins you already own, or even nothing at all. You then convert $1 billion into USD 1 billion and earn 20%. Every year you will make $100 million, and it requires zero effort to manage this position. Again, I have no idea how large of a USD position 3AC put on, but if we believe they had almost $18 billion AUM. At one point earlier this year, it is extremely plausible they borrowed billions to deploy to this carry trade.
Yes.
Your ability to borrow money rests on your collateral and reputation. The goal is to borrow money with as little collateral as possible. The less collateral requested of you, the more the borrower trusts you. 3AC adeptly built an aura of invincibility. It was a combination of calling the market correctly in the past, and aggressively telling everyone how well they traded on social media. 3AC at its height was one of the largest pools of dedicated crypto capital globally. This reputation for trading excellence, combined with the sheer size of assets they controlled, allowed 3AC to borrow on very generous terms. For example, Voyager, a publicly traded company, lent 3AC hundreds of millions of dollars without any collateral. 15,250 BTC and 350 million USDC. To be exact. Leaving them shirtless, pantsless, and utterly defenseless against the bullet that 3AC's default sent ripping through their dome. Game over.
This is so scary. Because this means that not only is the entire space at risk, but it also means that all the lending platform got completely wrecked because they had like way too nice terms for their lenders, which means that they reduced their risk aversion. Like they increased their risk aversion because of their trust they had for the different people. So they are like the big losers in this situation. Of course, 3AC as well, but it's quite crazy.
Game over. That brings us to my, purely speculative, thoughts on how 3AC began its slide towards insolvency. As I suggested above, I suspect that 3AC not only used its own capital, but borrowed USD from individuals and funds in order to play the USD carry trade. For the loans that were collateralized, 3AC posted a combination of Bitcoin, Ether, and, most importantly, various other less liquid and more volatile shitcoins as collateral. On paper, 3AC's portfolio of crypto assets was extremely impressive. But when UST broke the peg and the entire $40 billion Terra ecosystem collapsed in under a week, what was once a juicy carry trade quickly became a rotten nightmare, and 3AC's demise became a question of when, not if. When the market falls, it falls in a correlated fashion. This simple fact spelled doom for 3AC, whose pumped-up valuation stemmed in large part from the market value of the many extremely illiquid shitcoins they held. When the market started to fall, liquidity in these shitcoins evaporated, and the order book went offered only. The prices reflexively fell lower and lower in a nonlinear fashion as 3AC continued selling through rapidly drying demand, eventually making it impossible to recover enough USD to pay back the loan. 3AC suddenly owed a lot of USD that it didn't have and couldn't recoup, since the remaining assets that it could liquidate to pay back these loans had fallen 50% to 75%. If the broader crypto market had not fallen, 3AC might have been able to salvage the loss of capital tied up in UST and Luna. Instead, the market sniffed out a wounded lion and proceeded to eviscerate it.
Yeah, so I think this is where we see the importance of liquidity, right? Importance of liquidity. These funds, so I think like for retail like us, it doesn't matter this much, but I think it's important to understand in order to know how to position yourselves in specific assets, and also to understand what can a fund and what can, like how do hedge funds operate in such illiquid markets. They can't realistically exit their position, and most of the times they have lockup periods. So it means the real alpha in analytics is to understand when are the unlocks happening, how are they exiting their position or like de-risking their trade, right? So like when is the distribution period for VCs or for hedge funds, so that they can reduce their risk or exposition to an illiquid shitcoin, while it's still a risk asset and not like a finalized real thing theoretically. And yeah, I think like it's a really important conversation and topic, because liquidity is everything. Like the more you learn about all this stuff, the more you understand that in crypto, if there is no liquidity, there is nothing, basically.
Then the question started. Who lent money to 3AC? How much money was lent to 3AC versus how much collateral? What was that collateral? Did 3AC pledge the same collateral multiple times? Wah, so donga. And as the weeks drew on, various large centralized crypto lenders came under pressure. A number of the major companies declared insolvency and went cap in hand to the handful of crypto OGs with enough capital to restore their solvency. But, how could the default of one fund spiral into the near annihilation of an entire industry? You might be wondering. Great question. Let's take a closer look at how 3AC's whoopsie took down many of the largest and most high-profile centralized crypto lending players. Centralized crypto lenders. First, let's familiarize ourselves with the major players in the centralized lending space. Some of the big names currently feeling the pressure from 3AC's demise include Voyager, Celsius, BlockFi, and Babel Finance. Reminder, I have no non-public information about these companies. I only have the powers of deduction and public statements to go off of. Lending businesses are very simple. Lenders accept deposits and pay depositors interest in exchange for the ability to loan out their funds. The lender then loans out the funds at a higher rate than the interest it is paying to its depositors in order to turn a profit. The simplicity of this model comes with some pitfalls, with one of them being that lending businesses inevitably come under stress during any sort of financial crisis.
Okay. Okay, lending businesses stress tests. Lending businesses will inevitably come under stress during any sort of financial crisis. Conceptual mistake dichotomy, let's say. Lenders accept deposits and pay depositors interest in exchange for the ability to loan out their funds. The lender then loans out the funds at a higher rate. Interest is paying. Okay. Yeah, so the concept is based on the fact that people need to be able to pay back, and if they're fully allocated, they can't. So financial crisis leads to downfall of their entire system.
Crisis. Unless you work at the company, there is no way for depositors to understand whether the company acts in a prudent fashion with their capital. Therefore, at any sign of stress, you rush for the exit, and if the lender is taking any duration risk, they will quickly become insolvent. With that in mind, let me describe the safest way to run a lending business. Assume you have 3 customers, Mark Karpelis aka Magical Tux, Du Quan aka the King of Korea, and Su Ju aka the Sultan of Singapore. They each have 1 ETH and would like to earn a return on their assets. Each person has a time preference. Mark equals 1 month, Du equals 3 months, Su equals 1 year. Let's call the lender Long-Term Crypto Management LTCM. LTCM can be a safe lender or a risky one. If LTCM is being conservative, it will lend at maturities matching the time preferences of each person. Therefore, LTCM lends 1 ETH for 1 month, 1 ETH for 3 months, 1 ETH for 1 year. There is no risk that when Mark, Du, or Su ask for their money back, it is being lent out, and cannot be returned to THM. If LTCM is being aggressive, it will lend out in longer maturities than the time preference of each person. To illustrate this at an absurd extreme, LTCM could lend out 3 ETH for 10 years. Obviously, if any of the depositors ask for their money back on their preferred timeline, it won't be there. That is how a lender becomes insolvent. But LTCM could wager that it will be able to convince each depositor to roll over their deposit multiple times so that LTCM never becomes insolvent. This analysis only covers the duration of the LTCM loan book. The second aspect of a lending business is the quality of the borrower. A lender's value as a company stems largely from its ability to properly assess the credit risk of borrowers, and ask for appropriate guarantees or collateral based on those risk assessments before lending money. In crypto, there are 3 sources of demand for credit: carry trades and cash and carry basis trades. The borrower would rather not post collateral, as it wants to have as much cash as possible to most effectively use these strategies.
Okay. Yeah, so selecting your clients, I guess. The importance is the existence of a guarantee, because this is basically or breaks the business model. Like, this is their downside risk, right? So like the guarantee reduces the downside risk of a lending platform, while the overall how to put it, sorry, I'm not very quick today. Mentally quick. What did I want to say? Yes, so basically yes, so like we described, the lending platform wants to make profit of the lender by providing rates, and then, you know, they can generate yield on those rates. Like on the difference between the borrowing rate and the lending rate. And so here, their only risk is if the person can't pay back. Since we're in a decentralized system, you'll need some form of trust, or you need some form of security. And so this like selection is, I think, in this space even more important than in any other. Clients in DeFi even more important than in any other field. And then you go from there. And so here you understand also that there are not a lot of clients, at least for the very big ones. And so they don't really have a choice. And then if they want to keep the client or like have exclusivity, then it becomes complicated.
These strategies. You can read one of my earlier articles. All aboard. For a detailed explanation of the cash and carry trade. Margin loans for speculation. These are for directional long and short traders. Usually, they will post some sort of collateral. But failure to appreciate the changes in volatility and liquidity of the underlying collateral can lead to losses for the lender. Mining asset-backed loans. A miner either pledges hardware, like ASIC Bitcoin mining machines, or crypto and receives fiat currency and or stablecoin. These borrowers carry the least risk, as they have a strong crypto cash flow backing their loan. However, if you repossess ASIC machines...
So here, margin loans, calculation. So here it's for short traders. And then you have mining assets backed loans.
Machines from a defaulting miner, you must have a facility in which to plug in the machines and start mining to make full use of them. The major use case missing from crypto credit is business loans. This space is so new and risky that it makes no sense to lend to a crypto company. Crypto companies, similar to the underlying coins themselves, should be viewed as call options. In a default scenario, you will get wiped out regardless of where you sit in the capital structure. Assuming that, it's better to just own the equity, because at least you get to participate in the upside. Because of the inherent volatility of crypto markets and the supposed profitability of various yield farming, carry, and basis trades, borrowers have been willing to pay extremely high rates of interest. This means that lenders can offer retail depositors extremely high rates of interest and still have a positive net interest margin (NIM). I believe the major crypto lenders started out lending very sensibly, but then grew too quickly. The deposit rates were extremely attractive relative to what TradFi banks and sovereign governments offered on fiat currency deposits and bonds. This was the result of wanton central bank money printing and zero interest rate policies. Yield-starved retail investors could not get enough of these great yields on crypto and fiat stablecoins. The billions of dollars that flooded into these few companies outstripped the supply of responsible borrowers. They had to deploy the funds because it cost them money to acquire them. Remember, they are paying everyone interest. The pressure to lend out their capital forced firms to lower their borrowing standards, and also led them to engage in the very same carry trades as 3AC. See, for example, BlockFi used to be one of the largest holders of US-listed Bitcoin tracker fund GBTC. BlockFi accepted BTC deposits, created GBTC shares, and then sold GBTC shares on the market to capture the premium. That was the plan, anyways, but it took 6 months to create GBTC shares. During that 6-month period, between late 2021 and early 2022, the GBTC premium turned into a discount, and by the time they exited the ARB, they had lost money. If you have Bloomberg, search GBTC US Equity HDS Go. Then, look up BlockFi, and you'll see they sold their 3.6 million shares of GBTC sometime in the first quarter of this year. Above is a chart of the GBTC premium or discount to its net asset value (NAV). Given the 6-month lead time and humanity's penchant for extrapolating short-term trends ad infinitum, I bet many firms borrowed BTC to create.
So GBTC. BlockFi accepted BTC deposits, created GBTC shares, and then sold GBTC shares on the market to capture the premium. And until they created the shares, the premium was no longer one but discounts, e.g. BlockFi lost money on the creation. Yo Pestos, ça va? La forme? They had to sell 6 million shares of GBTC.
Create GBTC hoping they could reap a 40% profit 6 months hence. As you can see, that obviously didn't happen, because GBTC has traded at a discount since the second quarter of 2021. 3AC was able to put on such large carry and directional trades in large part because it had a willing pool of capital that had to be invested. In my mind, there is no other explanation why a listed company such as Voyager lent them hundreds of millions of unsecured dollars in Bitcoin.
Non, j'ai pas fait. Il est trop complexe le sujet. Mais je pense Pestos, en fait, de manière générale, même, je vais juste. En fait, le fait que je le stream, c'est juste histoire d'eux. Mais la réalité, c'est que je pense pas que je vais avoir beaucoup de viewers avec ça. On verra, tu vois. Mais juste, je vais stream en mode random et mettre sur mon YouTube. Et après, je vais prendre les notes que je me fais et je vais faire des vraies vidéos de 10 minutes autour de ça en français, expliquant les concepts et tout, de manière un peu plus technique. Parce que en fait, c'est littéralement du pur alpha, mec. C'est littéralement du pur alpha ce qu'il y a là. Littéralement. J'apprends genre 10 000 trucs par article, gros, ça n'a aucun sens. Du coup, ce que je vais faire, c'est juste, je vais continuer de faire ça. Et en vrai, c'est juste pour alimenter la chaîne. Ouais, je comprends, mais ça sert à rien en fait. Vaut mieux prendre un peu plus de temps et faire de la production et ça va être plus sensé, tu vois. J'ai pas aussi non plus de mettre ma tête sur des clips qui n'ont aucun sens. Pour gagner en visu, il faut faire masse vidéo. Ouais, bah mec, je suis d'accord, hein. Je suis d'accord. Je suis complètement d'accord. Comme tu veux. Non, mais la réalité, c'est que, en fait, c'est difficile parce que beaucoup de ces sujets, je les maîtrise pas encore. J'ai pas envie de faire des clips à la con où je maîtrise R, tu vois. T'as regardé quoi? Oui, mais faut juste spam, mec, hein. Faut spam, 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 hein. 100%. Faut spam tous les réseaux 10 fois par jour. Tu spams. Ouais, et le site, ouais. Et après, l'idéal, c'est il nous faudrait une newsletter et qu'on écrive des articles. Plus qu'on se mette sur une LinkedIn aussi. Pour tous nos tutoriels fonda et tout. En gros, il faudra que le point de vue trading, on le garde vraiment purement YouTube, TikTok, ça marche mieux. Et le côté fonda et tout, on le met plus sur LinkedIn. On met plus sur LinkedIn, Twitter, YouTube. En fait, le fonda, tu peux le mettre un peu partout. Tu connais mon orthographe. Oui, mais c'est moi qui vais faire ça plutôt, tu vois. Tout le côté fonda et tout, tout le côté fonda écriture, ça va plus être moi. Ça va plus être moi. Mais ouais, c'est chaud quoi. TikTok te pisse dessus. Ah ouais? Mais trop bizarre, non? Ça a bien marché à un moment. Je pense qu'il faut montrer sa gueule et parler de Ponzi pour faire des vues. Je pense pas forcément. En vrai, je pense juste qu'il faut faire des contenus. Je sais pas. Zéro vue hier. Mais oui, mais t'as copié le titre aussi. Et puis, on a aussi, et c'est un peu le problème, c'est que comme nous, moi, j'utilise pas TikTok. Et les gens du Discord n'utilisent pas TikTok non plus. En fait, t'as personne qui te fait les likes initiaux. Je suis sûr que ça carry de fou sur TikTok. J'ai fait combien de vues sur ma vidéo? Sur ma chaîne? Putain, 37 vues, mais what the fuck, mec. Ouais. With a lot of shows. Donc juste on continue, hein. Enfin moi je vais juste continuer ce que je fais gros et on verra bien. Le contenu est turbo technique mais... Mais j'ai contacté déjà Pestos. J'ai fait déjà. T'inquiète. T'inquiète, j'ai fait déjà. De toute façon on a le partenariat là, le premier qui va être annoncé bientôt. Donc on va avoir les premiers boosts. Et après on va contacter des gens. Faut juste qu'on continue, hein. Faut pas se démotiver là. On s'en bat les couilles des vues hein, là maintenant. C'est juste il faut qu'on ait une base. Puis même les vues sur YouTube ça va gros, hein. Ce que j'ai vu. Oublie pas, hein, c'est du long game, hein, je t'avais dit, hein. Je t'avais prévenu. Juste qu'on continue de grind et parfois faut pas se poser trop de questions, tu vois. C'est qui le premier? Le premier, bah, c'est Nakmerdit, c'est le truc de Meetup là. Ouais, bah let's go, gros. Mais t'inquiète, mec, on va s'en sortir. On va s'en sortir. Puis la valeur qu'on apporte, elle est zéro encore. Dès qu'on va commencer à faire des tutos et tout, là, ça va être sérieux, tu vois. Faut qu'on se call d'ailleurs pour faire le planning. Bon, bref, attends, je vais finir mon article et on peut parler après.
3AC said they would pay a high rate of interest, and Voyager took their word for it because in the minds of Voyager's principals, there was no other outfit with 3AC's pedigree that could absorb the amount of capital that needed to be shipped out the door. As Chuck Prince so eloquently quipped in response to Citi's participation in originating subprime mortgages,
Yes.
when the music stops, in terms of liquidity, things will be complicated. But as long as the music is playing, you've got to get up and dance. We're still dancing. Unfortunately, the lenders were all on the same side of the trade. They had the same borrowers. They held the same collateral. And the borrowers all lost money on the same carry trades. The only difference between 3AC and these lenders was their ability to market themselves. As we can see, none of them engaged in proper risk management to the degree required to weather this particular storm. To make matters worse, these are private companies who do not have to routinely publish updates on the health of their loan books, nor do they have to set aside reserves in anticipation of bad loans like publicly traded banks. We are left to speculate on the size of the potential losses these lenders face without any moorings. As a result, everyone attempts to pull their money at the first sign of stress, which, if the lender has duration mismatches, is the exact recipe for insolvency.
Yeah.
And this is exactly what transpired, as the market wondered how large of a hole 3AC had punctured in these lenders. It wasn't just retail pulling out, either. These lenders also traded the same risks amongst themselves, meaning they also had exposure to one another, and they didn't trust each other either. This complete loss of confidence in centralized opaque lending outfits is why they almost all went extinct at the same time. Half-time. To quickly recap, 3AC blew up because they took boring, stable, and predictable arbitrage strategies, strapped on an egregious amount of leverage, and succumbed to the market after the Terra USD carry trade meltdown. Due to their perceived investment acumen and large pool of assets, 3AC was allowed to borrow with little to no collateral by lending companies eager to redeploy retail deposits into high-yielding crypto credit instruments. These lenders, such as BlockFi, Babel Finance, Voyager, and Celsius eschewed prudent risk management policies in order to get as many loans out the door as quickly as possible. As a result, when 3AC failed to meet margin calls, these lenders were left holes the size of the Mariana Trench in their balance sheets. Unfortunately, these once celebrated, billion-dollar-plus valued fintech startups are now headed towards insolvency first and the glue factory later. There is nothing new or innovative about how these lenders became insolvent. For as long as there have been centralized lending businesses, there have been epic failures such as what this crop of crypto lenders experienced in this circumstance. The technology that underpins cryptocurrencies and DeFi has nothing to do with why 3AC and these lenders got into trouble. Now that it's clear this was just a run-of-the-mill failure of a coterie of poorly risk-managed financial institutions, let us delve into how the actual crypto and DeFi applications handled these market stresses. Terra USD worked. The Terra ecosystem was DeFi to its core. A group of engineers launched a codebase, visible to whoever would take the time to investigate, and these lines of code govern how the UST algorithmic stablecoin would behave. The UST code was executed 100% as designed. It worked, but investors did not care to understand how it worked. So, when the peg broke to the downside, the recursive logic governing how Luna and UST were minted and destroyed to balance the ecosystem wiped out 100% of the ecosystem's value. This is purely maths and was more or less inevitable. The fact that many refused to read the white paper is not Terra USD's fault. DeFi lending protocols.
I agree with this.
The other group of entities that lent money to 3AC and various other addresses in the crypto ecosystem were DeFi lending protocols. The major ones that played a part in this melodrama were Compound COMP, Aave, AAVE, and MakerDAO, MKR. When you lend in a decentralized fashion, there are no arbitrary decisions made by individual humans. That means the protocol cannot factor any trust-related data points into its decision on whether to loan funds and how to secure them. The protocols, which are governed by the community, have sets of rules which clearly state the type of collateral required and its amount. If I want to borrow USDC with Bitcoin collateral, the protocols will require the borrower to over-collateralize with Bitcoin. This is because Bitcoin is the more volatile asset versus a fiat stablecoin, such as USDC. Usually the initial margin is 150% of the value of the USDC borrowed. If Bitcoin is $100, and I want to borrow 100 USDC, then I must post 1.5 BTC as collateral against a loan of 100 USDC.
Interesting.
If the price of Bitcoin declines, usually to a set level of 120% of the value of the USDC loan, the protocol will immediately and programmatically liquidate the Bitcoin so that, in most cases, the 100 USDC is returned to the lender. These levels are established at the protocol level and can only be changed if enough of the governance token holders agree to loosen or tighten lending standards. In fact, during this current crisis, some lending protocols have changed their policies. These changes had to go through a series of community-driven governance votes to be implemented. Wow, isn't it amazing when decision-making can be done quickly, efficiently, digitally and in a programmatic fashion by self-interested parties? Just to give you an example, here is a recent proposal. Adjusting Compound.Finance's collateral factors, which was approved by the DAO governing the protocol.
Let's look at it. Set parameters June 14th votes. Okay, it was one-sided. Queued June 11th. Executed. Created the 5th. Active the 11th. Succeeded the 14th. Executed the 14th. Interesting. So in 3 days, basically, they could completely change their protocol system. CUSDC collateral factor to 84%, etc., etc. Background gauntlet simulation engine has ingested the latest market and liquidity data following the recent market crash. Is batch update of risk parameters to align with moderate risk levels chosen by Compound community. This is super interesting. Value at risk, liquidation at risk. Yeah. So basically they are doing like projections and they use the DAO with the parameters to explain what they're doing and why. I mean, this is like the perfect use case of a DAO, right? In this specific scenario. Super interesting. Very cool. So yeah, it's crazy. In 3 days, they could manage to change entirely the parameters with a unanimous voice. It's pretty cool. More usage by 8 basis points. No change in value of risk or liquidation at risk. Okay. Take a look.
Governing the protocol. The only information that these protocols have about a lender and borrower is their Ethereum wallet address. To them, 3AC is just an address with a balance. It is not a collection of humans with a certain pedigree that indicates they can and should be trusted to pay back what is owed even when no collateral is required upfront. I will repeat, these lending protocols are designed with the explicit goal of removing the need for trust from the lending equation. These protocols control loan books in the billions of dollars. Their lending standards, their borrowers, lenders' addresses, and their liquidation levels are completely transparent as it is all published publicly to the blockchain. We can evaluate the health of their loan books in real time. Depositors in these protocols can process all the relevant information about the health of these protocols before they deposit their funds. Contrast that with the opaque nature of centralized lenders, where the depositors only have slick marketing campaigns to consider. 3AC and the cabal of centralized lending company bag holders all participated heavily on these DeFi lending protocols. We know this because using blockchain analytics tools,
the only information that these protocols have about lenders and borrowers their Ethereum wallet address. To them, 3AC is just an address with a balance. It is not a collection of humans with a certain pedigree that indicates they can or should be trusted to pay back what is owed, even when no collateral is required up front. I will repeat, these lending protocols are designed with the explicit goal of removing the need for trust from the lending equation. Okay. The lending protocols are designed with the explicit goal of removing the need for trust from the lending equation. This is super interesting, mainly because we see that the decentralized lending platform outperformed the centralized lending platform that basically went to zero. So it's like a new model that has proven its efficiency in this crisis. So we see that like human error has a big impact on this specific market, which is pretty big.
Market participants were able to ascertain where certain companies would get liquidated on the large loans they had outstanding on these protocols. The market is cruel, and it systematically hunted for levels that would force the protocols to sell indiscriminately in order to make its lenders whole. And thankfully, due to the community stipulating conservative margin requirements, all of these major DeFi lending protocols survived. The protocols did not have to halt any withdrawals. The protocols continued to issue loans. The protocols did not suffer any downtime. Rectum damn near killed them. When you remove trust from the equation and rely purely on transparent lending standards executed by impartial computer code, you get a better outcome. This is the lesson to be learned. Don't let the media proclaim the failure of these centralized companies as evidence of the shortcomings of the good Lord Satoshi. For he saved those who deserve saving. The problem now is that with hundreds of thousands or millions of humans wrecked due to the contraction of centralized crypto credit, who is left to borrow funds? That is the issue these DeFi lending protocols will grapple with as this nuclear bear market marches on. At some point, the price to book multiple for these DeFi lending protocols will become attractive again. Currently, they still trade too expensively given the near-term outlook for loan demand. With the speculators, large trading houses, and centralized lenders wrecked, there is no pool of large organic demand for loans. Maybe I'm just being greedy, but I hope the market gives me an opportunity to own Comp, Aave, and MKR at a much lower level before we exit this bear market. Thirst trap. Water, everywhere. And all the boards did.
Yeah, it's interesting. So basically he's bearish. So he's saying these protocols are relatively bearish from a price perspective because they will have less adoption, less use case. But on the other hand, he thinks that these protocols are really winning, like compared to centralized systems. So in the future, we will see way more decentralized lending protocols, but it requires more liquidity and therefore demand. So yeah, I think great takeaway in general, just showing that like decentralized tools are stronger than centralized tools, and that the future is in those decentralized tools. But the reality is that for now, there's low adoption, and that mainstream trends are like the thing that is advocated by all this drama and all these problems is that the lending protocols are failing. But in reality, they were just working as designs, while the centralized lending platforms, they over collateralized because of the human nature of the transactions they are making, and those got completely liquidated and lost everything basically. So this is like the main takeaway.
Did shrink. Water, everywhere. Nor any drop to drink. The rhyme of the ancient mariner, Coleridge. Centralized crypto lenders be thirsty. However, should the sweet succor of capital be provided to these parched zombies? For crypto hedge funds such as 3AC, their intrinsic value rests solely on the ability of their portfolio managers PM to take risk judiciously and make money consistently over time. If a group of PMs blew up because of an improper use of leverage, what value is there in the fund they control? I suspect that 3AC made frantic phone calls to Baron CZ and Baron SBF, but what would the nobles be buying exactly? A hot mess, that's for sure. And I suspect that 3AC and funds in a similar position will find no savior. When it comes to the crypto lending companies, their only value rests in their client list and a tiny fraction of good loans. If these clients can be retained and sold additional crypto financial products, then it might make sense to purchase the crippled centralized crypto lender for a song and assume their liabilities. Their radioactive loan books might contain a few properly underwritten loans, and these loans can be purchased at attractive prices. The problem is that the longer these lenders go without a lifeline, the less likely it becomes that they will ever reopen and allow their retail depositors to withdraw. The time pressure to conduct due diligence on these opaque entities makes it even harder to accurately assess whether the crypto barons will part with their capital and save these sinners. Surely the Fed or another central bank could bail out these hedge funds and companies, but these entities dealt in crypto. These entities are not part of the club of TBTF financial institutions, and shall therefore die an ignoble death. But let us not shed too many tears, for we have learned through these trials and tribulations that the promise of a new decentralized financial system has weathered yet another test. Number 3.
Cool article. Very cool. I think that's a great takeaway. And a great conclusion. Yeah. The power of decentralized tools, guys. It's endless. So what are we doing? Are we listening to another one, or am I cutting it now? I don't know. How much more energy do I have? Let's listen to one more, maybe. I love how he writes. I mean, this is super good. Super good article. Very insightful. I'm also interested in like the alternatives for cash and carry trades. I'd love to learn more about this. Luna Brothers, Annihilation, Bottomless Maelstrom, Yango Utility, Dowd, Laylo Mo. Which one do we listen to? Yeah, actually, I would like to just cut the stream and do something else. I have a lot to do. So, yes, I think I'll cut it here. I need to finish some stuff and I need to go later, so I can't. Okay, so thank you for watching, everyone. Very cool article. Lending protocols are a big thing. But yeah, so short term, most probably bearish because no use case. But long term, I think we'll see an even bigger domination of decentralized protocols like this, and it makes a lot of sense for lending platforms because it's automated liquidation. So I think this is like the superior model. Okay. Take care. Have a great day, and see you next time. Bye-bye.